Welcome to the show. I'm your host, Chris Wofford.
Hi, I'm Jan deRoos. Looking forward to a fun-filled half an hour.
Yeah, you bet. On today's show, we're looking at the post pandemic real estate landscape. We're going to try to get a handle on where we are currently and what's in store for what is otherwise an extremely volatile industry right now, fraught with peril and deep uncertainty. Jan deRoos, talk us down, please.
Well, it is fraught with peril and has a lot of uncertainty, but I think there is hope.
Good.
So let's start there and take a look.
All right, I dig the attitude. Professor deRoos, of course, is a faculty author of Cornell's Real Estate Investing and Finance and Commercial Real Estate Certificates, two certificates for which we will share the URL. If you find what we're talking about compelling to you or relevant to you in your industry and your line of work, check out some of these certificate programs. They're excellent, and Professor deRoos is the guy. So we'll share those URLs in the chat with you. Viewers, we do need your input to get things moving today. So we're going to open up with a poll question. This comes in word cloud form, open text. I want to know who's in our audience today. Maybe it'll help us tune our conversation. We'll be speaking to we want to know who we're speaking today. So are you, and these are just some examples, an investor, a landlord, a property manager, a business owner, a commercial space tenant, right? So whatever your role might be, whatever field or industry you work in, or your role as it relates to real estate, please enter that in the chat here. And then we'll kick off the conversation. So Jan, in our pregame huddle, we were talking a little bit about real estate. You told me that commercial real estate has become toxic to own and finance. Where are we?
Yeah, I said before, never in my career have I seen real estate so negative. I may qualify that to say rarely in my career have I seen sentiment on real estate so negative. There was I came to Cornell after the 1980s meltdown in real estate. So there are these meltdowns from time to time, but this one not only is affecting the cost of capital, which has gone up, but it's affecting the availability of capital. And I think that defaults due to the inability to refinance property will be a real test for the industry. All lenders are making plans for increased what are called refinancing or refi defaults, in addition to an expected increase in cash flow defaults in certain property types like offices and maybe some retail.
Jan, thank you for that. I've got some feedback on who's in their audience today. I think we have the right people in the room. So overwhelmingly, commercial space tenant and investor are the top two represented groups of people here: developers, business owners, architects, realtors, homeowners, real estate brokers. Right. So we have the whole gang here today as part of the conversation. So speaking of which, viewers, so if you do have questions for Professor deRoos, just drop them in the chat. I'll see them here, and hopefully we'll have time to get to those today. We are going to be running a 30-minute session, so breakneck pace here today. A second poll question. This one ought to be fun now that you've got it opened up. Which three of you in our audience have received financing this year? The answers are, number one, I've received financing. No chance is number two. And three, I don't understand financing anymore. So we'll see how that one shakes out. In the background, Jan deRoos, I want to ask you what's going on.
So anecdotally, and
Yeah.
it's been reported in the press, two very large mortgage REITs reported that they had no loans to new clients this year. And equity REITs are trading at reduced pricing. And so their pricing probably is too low to justify offering stock to do transactions. So both the debt financing markets and the equity financing markets have really, I'll call narrowed the amount of liquidity that's there, in addition to the money that's just there because real estate is toxic, is causing problems. There's some increased, a lot of the problems we have is what I call the macro. So it's not real estate that some of the problems are above real estate. It's in the macro economy with interest rates rising and real estate being so dependent on debt capital. It just hurts the returns to equity and quote unquote craters a lot of deals. Regional banks we've had a crisis there recently. Regional banks are in a lot of pressure to clean up their balance sheets, bolster them, and the value of the existing real estate loans on their portfolios is being questioned. So if you're going to have questions about whether or not those loans are, at value or not, why not just sell them or get rid of them or not do any more lending to real estate? And then the third thing is the big scramble this year has been by borrowers to try to secure extensions to existing loan agreements. So you may have something that's coming due at the end of this year, next year, or the say 2025. you might be wanting to talk to your lender right now to secure some 1 or 2 year extensions, even 6 months extensions, to push things out until there's more certainty on where rates are going to end up and if there will be any decline in rates. So I think those are the financings we're seeing is the extensions, but they're not really financings, true sense of the term.
Yes, good. So I've got to follow up real quick on that that joke question from a
Oh,
moment ago.
yeah.
21% of our audience has received financing. 50% say no chance. I don't know what kind of data set we're dealing with, but that's probably what we anticipated and probably in line with your thinking as well.
Yeah, I mean, it was a bit of a sort of a fun question,
Yeah.
but the idea is financing is really hard to get. And I don't want to be too flippant about this. This is a very difficult time to be securing financing. Anytime these large investment funds, the private equity firms announce a new fund to go after distressed real estate. These are smart people with a lot of money behind them, and I think they're betting that there will be some defaults this time. Although everyone was wrong in 2021, the fire sale of 2021 after the pandemic hit in 2020 did not happen. So, may have been pushed out a little bit, but refinancings, I think, in the face of rising interest rates are a real problem. The problem is the same amount you were paying today for your debt service on your building gets you a much smaller loan now because so much more of it goes to interest rates. So people are either going to have to write checks to put money into their property, or they're facing a default.
You mentioned that both interest rates and liquidity are extremely hostile to sale and purchase of real estate right now. How is this
Yeah.
affecting holding periods?
So it's unfortunately your holding period just got longer.
No.
If you can't sell, if you didn't want to, if you can't transact. So I think it's an opportunity for you or for investors to really take a hard look at investment in both property management and asset management skills and talent. This talent becomes abundant actually when there is a downturn like this. The people that were the transaction specialists can, the hunters become farmers. But investments in farming, running your real estate well, managing tenant turnover, managing the asset, going back, the great article last week in the Journal about how San Francisco property owners are systematically going back to the city and asking for reductions in property tax due to reduced valuation. So it's time to pull out all those tools from your toolkit and really do the things you need to do, both if you're not going to get rents, and office especially has a problem, and your costs are increasing, anything you can do to manage your costs will be a good thing.
So, big picture here, and let's go through this by sector. I want to know what's going on with real estate supply and demand. Let's look at, multifamily, retail, hospitality, medical, what's called logistics, properties, offices, et cetera. Can you break it down and let us know how things are looking in each of those sectors?
The great news
is it?
Because interest rates are rising and most construction in the U.S. is done via construction loans, there's not much new construction. So
Okay.
new supply coming to market is really slowed down. It's very, very difficult to get a new project approved.
Yep.
So we're probably dealing with the existing supply. But you really can't broad brush real estate. It really is multi-asset class. And I prepared some notes here to talk about the various asset classes. But the big story, again, is the cost of other people's money, and therefore that affects the returns that equity investors are willing to accept. But multifamily, single family, the prices on that went way up. It may have gotten priced a little bit, but it was a darling asset for the last few years. Rent growth is slowing. Some markets will face headwinds with new supply. I mean, if you go to the southeast, like especially where I am, there is a lot of new construction because people are seeing rents when rents were bumped 15-20% over the last 2 years in many markets. That changes the economics as well. Retail in the U.S. and most Western economies are just simply over retailed. And there is a big shakeout happening in retail and a repricing, and that stuff will get repurposed. Generally, it's a filtering from the new thing comes on the market, and the old things tend to filter out and become reused. The long-term story is that real estate, gets repurposed, and unfortunately, in declining markets, a lot of this stuff will get abandoned for at least some time until basically it gets sold for its land value.
Yeah.
And then gets done. There is some movement to try to grab things before there is decay in the neighborhoods around them, repurpose them into some sort of affordable housing. And that's a movement that will take some pump priming, I think, from local governments
Yeah.
or state governments to help get that going.
That's the way things appear to be going, and definitely in local municipalities, certainly around here.
Yeah.
Yeah.
Well, certainly I mean, there's a market change between, the Northeast where I used to live in Ithaca, and then I
Yeah.
live now on the west coast of Florida.
Yeah.
But even here, there's the old malls and the new malls.
Yeah.
There's a lot of very empty space all over this city where I live in the greater Sarasota area.
Yeah. Sure. What about warehouses?
Warehouse, very similar story to what's going on in apartments. Darling asset, logistics is in supply chain and last mile, and having both the big centers and then the last mile centers has become important. But so rent growth is slowing though. But credit tenants can help with financing. I recently saw financing that was 100% Amazon occupied. The strength of Amazon under long-term leases made that an eminently financeable asset. But Amazon, I'm sure, is insisting that the owner craft the building to Amazon's very specific needs.
Yeah, perfect. Let me pause real quick. I see that some audience questions are coming in. Jen, we'll take some of those in a minute.
Oh, sure, that'd be great.
I wanted to give you a second before we dive into the industrial. What's cooking on that front?
And another darling asset, especially with Build Back Better Act, onshoring, green and industry growth. A lot of it is being repurposed, but there's a lot of high quality industrial property with proximity to rail and interstate, and local authorities are willing to help with utilities and some repurposing. And then the federal government's got a lot of money to help with especially transition to a green economy. So I think this is a place where there's a lot of it'll take some money to repurpose. So but when you can buy things for $50-$60 a square foot, put $20 a square foot into them, and really significantly change the trajectory of rents, that's a compelling story.
Yeah.
There are some of those stories around. Now, the newest space is going to cost you, well over $100 a square foot.
Yeah.
But with the tenant then spending equal amounts of money to fit it out inside for their needs.
Towers.
So new asset class, cell towers.
What's
Small
that
piece of land, long-term rents, credit tenants, all works. Largest REIT in the U.S. is now a tower REIT. Who'd have thought?
Yeah.
And
what are the opportunities there?
You have to own American Tower. But they're a dominant player. I think there are some other companies out there, probably priced to perfection currently.
Okay. Right.
Would be my guess. Educated guess.
Yeah. What's going on in the medical world? You were talking about
medical. So again, you get into this. It's asset class by asset class. Medical office buildings, aging America. There is new drugs. These new weight loss drugs will change some things in terms of how healthcare gets delivered. But I think, given the aging of America and just demographics, medical office buildings have done well. You need to keep up with technology to keep your buildings competitive. But the best practices are seeking to get out of owning space and renting space, and concentrating on their core business, which is treating patients, and let somebody else take care of space. And when you can, move into a space that's got the technology that you need, that's a compelling story.
So what do your notes tell us about lodging? What's going on in that?
Oh, that's my former wheelhouse, or taught at the Nolan School for years and years.
Sure.
It's a classic risk reward asset. I mean, hotels closed, right? They were shut in 2020, and then they reopened in 2021, and people tiptoed in 2022. It was like, I can't get a hotel room, and the stinkers are charging me a lot of money. Those stinkers, and it made gobs of money. But now rent growth is slowing. So labor intensity industry will continue to cause challenges. I mean, the industry is responding. I don't know if you stayed recently, but you don't get your room service if you're staying 3 days or less. Is a new expectation. I don't know how long we can live with that, if it'll creep back in, but managing labor, I think, is a big challenge for that industry. And those who do it or have a low labor model will do well at the expense of, I think, those that have a high labor model.
So we're in the post-pandemic, what we consider post-pandemic period. This 3 years. We've been in a mode where there's been movement for businesses to return to office, right? With varying degrees
Right.
of success, depends on where you are and who you work for. But what are you seeing in that space? How is that influencing or not influencing uh, current market
Yeah.
volatility or otherwise?
So I've been studiously avoiding talking about office because it is both the elephant in the room and everybody wants to talk about it as well. So nobody wants to talk about it and everybody wants to talk about it. One of the big stories today is whole building office to residential. Um, and that's a really interesting story. Mostly, I'll call in the luxury residential space. It is really hard. It is really expensive, and it's really, again, not a solution for low-cost housing needs. It usually involves some sort of light well that gets cut into the building on a very simplified way. Think about it as just cutting a big hole in the middle of the building so that you can get some light to the interior units. Otherwise, it just isn't going to pencil or work as a residential building. You're just not going to get light into the space.
Mm-hmm.
So, and that structurally is something that's very difficult. So you buy a building for, in a major urban core like New York for $500-600 a square foot, and then you have to put another, $500-600 a square foot into it. Now you got to sell your units for at least, the 1,200. You're going to break even, so $1,500 to $1,800 a square foot. That gets expensive really fast. $1.8 million for a 1,000-foot space. Those that gets really expensive really fast. So it is a solution. It takes time. And once you converted a office building to residential, you have a residential unit in an office district. Do people want to live in, play in, send their kids to school in something that is an office district? So the streetscape and how that works is interesting. I think the larger scale things where either like what Battery was done in New York with Battery Park or what's being done now with Hudson Yards in New York are two good examples of creating these integrated neighborhoods. That I think is the future. And that'll take some vision and probably I would call some really big money to buy blocks and work with the owners of those buildings to really transform them into a different kind of a streetscape. But I think that could work, but it's going to take time. There may be a floor by floor solution in some areas, but we were just they're not a viable entity anymore. So converting a floor at a time and using it is going to be hard. But I don't think this has the potential to create any sort of scale or large amount of space. And then you asked me to speak about the relative desirability of urban versus suburban locations. And I think the work from home and the back to office BTO, both of those, they're in tension now. It's a huge tension. But what many companies are now doing is realizing it's going to be really hard to keep my best talent if I absolutely insist on work all the time. And then I'm really kind of a stinker about where work is. So how about if I bring work closer where my people live or make it easier for them? So I think suburban office is going to be a net winner at the expense of urban for a while as this all plays out. So those are my thoughts. There is hope, but I think office building, there's not much of it.
Yeah,
To be frank.
which leads me to ask. I mean, we talked about all these office property vacancies that are happening in the urban cores you just described. What does that mean for suburban demand? There's more to talk about there. Can you tell us a little bit about what you think about that?
Yeah, I think the suburban the that suburban lifestyle that was really celebrated in the 90s and that where you worked in the periphery of the city. That's where your life was. That's where your job was. All the restaurants. Tyson's Corners is a great example in Washington D.C. or some of these other Gallerias in Houston or Dallas, or the periphery and Atlanta are great examples of this. I think those have an appeal now, and they have a renewed appeal. There was I would say, the last 15 years of more, the large tech companies headquarter themselves in urban cores, Google in New York, Facebook in San Francisco. And I think that the ability for many of those employees to be pretty productive at home, I think that's the big story, is if it's truly productive, the CEOs have to start dealing with that. If we have this, maybe more people to churn out the same amount of work. But
Yeah.
I really think someone who figures out how to reinvent urban cores, and I think they will come back. But I think we will be much more integrated in terms of residential and office being more integrated together rather than office district versus residential district.
Yeah, it'll be interesting to see how that plays out. I've got a bunch of viewer questions coming in, Jan. Let's take some of those.
Yeah,
I've
that's
got one
great.
from Michael who asks any historical reference we can learn from going forward with investment decisions. Any precedent for what's happening now?
Yeah. So here's what I've learned over 4 cycles in my career, which is recoveries are V-shaped. They're not L-shaped, they're not U-shaped, they are V-shaped. Well, things go down, things come back up. And so sometimes the strategy is no more sophisticated than waiting for things to get better. Okay. Now things are pretty good right now. The thing that got bad was, well, first the government pulled the plug on all the money that was pump priming during the pandemic, and then they raised interest rates. And both of those have hurt real estate. But I think longer term we'll grow out of this. The other thing is the historical antecedent is the old bumper sticker from a real estate guy is, "Dear God, give me another bout of inflation. I promise I won't screw it up this time." Because you get to raise rents. And hopefully you get to raise rents in a way that's faster than your costs are increasing. Now, again, I think lodging has a problem there, but I think most of the rest of real estate is pretty low labor intensity or low other cost intensity. So, but when your cost of capital goes up as much as it has, it does throw some monkey wrench in the thing. So waiting for things to get better is maybe just outwaiting the Fed and see if they can't get inflation down.
All right, let's pivot a little bit.
But meanwhile, raise rent.
Well, there you go. There's some actionable advice. So here's a question from a viewer who asks, we are launching a private equity fund focused on middle market industrial with open storage. How long should we hold properties for investors before we exit?
I think, I mean, if you're, if you're building from scratch, you need to hold for 4 or 5 years to your, at least until your IRR start to normalize. I think if you're a flipper and you're buying, you're fixing, you make your money by moving in and moving out, but that may not be your strategy. I think, sometimes you can be a flipper and buy things wholesale and rent them retail and make really good money for a very long time, and then recoup your money via refinancing. That's been a great real estate story. So it's not that I have to sell it to quote unquote make money. I can just refinance it because its value has gone up, and that's how I harvest increases in value on a partial basis. That's a great story, and I think that'll continue as well. But the typical holding period is much longer than 5 to 7 years. Mean you're really a long-term holder, which is a different kind of dynamic from what I'll call someone that is focused on maximizing the exits.
Nice question. Good advice. This one is a little specific. This is a specific case, Jan. If you want to pass on it, you let me know. Jeff asks, what do you think is going to happen with commercial office buildings in downtown Los Angeles, and in particular those owned by Brookfield DTLA? Are you familiar?
Yeah, I'm familiar with both firms. I think that the large institutional owners of real estate have a problem in these large urban cores. I think LA is in many ways is no different from Atlanta or Seattle, or San Francisco. Now, San Francisco's a basket case and Seattle's tough with their tech focus as well, and losing those jobs in addition to the work from home. LA is a pretty resilient economy, but who knows how it's driven by the entertainment. So the strike's really hurting it right now. I can't speak to specifics, but what I can say is these large institutional owners have been slow to sell and not recognizing drops in value. And it'll be interesting to see how much longer they do that, or their shareholders, their unit holders will allow them to do that, and not just harvest the losses and move on. Just give me my money back. I want to put it in AI.
Yeah.
Yeah, I mean, it's a money loser. Come on, guys, just give me my money back. But these large institutional holders, are it's hard to get your money out. There's a limited, so-called liquidity window every year for people to redeem their shares in these private equity funds.
Great. Thanks for the question, Jeff in Los Angeles. I have a question here from Mauricio who asks, isn't that reconversion, we're talking about office to residential, extremely expensive? Wouldn't it be better
Oh yeah, I mean, but the story I laid out came from a thing I was listening to about 2 weeks ago, where it was a New York City developer was talking about acquiring things at a bargain at $500 to $600 a square foot, and de minimis putting in another $500 to $600 a square foot. So he's all in at $1,000 to $1,200 a square foot. He's got to sell for $1,500. So again, 1,000 square foot unit for $1,500,000 is what he's looking at. He says I can sell them, but it's not easy, and these things better be they better be working well. The developer had some success stories, but he said it takes time. This is not one size fits all. It is expensive.
That
And
was
it's certainly not a solution for low-cost housing.
this is a two-part question from Mauricio who asked, then, wouldn't it be better to tear down the existing building and construct a new one from scratch?
Yes.
Yes, is the answer.
In many cases, yes, and that's really hard to swallow
Yeah.
because the current owner of the building has to take a big write-down, and that's what I was talking about previously, is when do you take the write-down and when you just walk away.
Grant asks, interest rates are important, but what is happening to the property values and consequently balance sheets, et cetera? This one came early in on our conversation.
Yeah, it's hurting it's at good bank regulators are asking questions about the true value of the real estate loans. Right? So your balance is say 100 million or 100 billion, whatever it is. But when I mark that to market and say how many of these are going to default, I mean, what's really going on with this, the value of those might be less. So people are asking hard questions about the value of those loans. In terms of individual building valuation, if you don't have to sell, it's moot. If you have to transact, again, if you have to, meaning refinance, then an appraisal matters, and the value that, you're going to get a loan based on either value or cash flows at a current interest rate. So, and a debt yield, which is another metric that's used to measure the relationship between cash flow and the amount of money you're borrowing.
Professor deRoos, I knew you'd come and bring some clarity, give some direction, maybe possibly a sprinkling of hope. I appreciate you joining us today on the show. Take care, okay?
Yeah, there is hope. Thanks, Chris. Appreciate it.
All right, you bet.